Quick question. Did you know that in the United States, homeowners can deduct their mortgage interest from their taxes? In Canada, we cannot. Our mortgage interest on our principal residence is not tax deductible, which honestly kind of sucks. But there is a legal strategy that lets you convert your mortgage into a tax-deductible investment loan. It is called the Smith Manoeuvre. It was created by a Vancouver financial planner named Fraser Smith, and it is one of the most powerful wealth-building tools available to Canadian homeowners. Almost nobody uses it, and even fewer people explain it well. Hi, my name is LJ Aguinaga, your real estate expert. I have been in the market for over 18 years, and today my goal is that by the end of this video, you're going to understand exactly how the Smith Manoeuvre works, who it's for, who should not do it, and here's where I come in, how to connect it to real estate investing specifically. Let's go. Here's the basic idea. In Canadian tax law, specifically Section 21C of the Income Tax Act, if you borrow money to invest in something that produces income, the interest you pay on that loan is tax deductible. Dividend-paying stocks, ETFs, rental properties all qualify. Your mortgage, not deductible, because it is personal debt. You borrowed to buy your home, not to invest. What the Smith Manoeuvre does is gradually convert the first type of debt into the second type. And the key word here is gradually. Your total debt does not increase, it just changes forms. Think of it like two buckets. Bucket A is your mortgage, non-deductible, shrinking as you make payments. Bucket B is a line of credit, tax deductible, growing by the same amount. The total water level stays the same, but over time, all your debt becomes good kind, the tax deductible kind. Okay, here are the actual steps. Step 1, you need a Readvanceable mortgage. This is a mortgage product that combines regular mortgage with a home equity line of credit, a HELOC. The key feature is that as you pay down your mortgage principal, your HELOC limit automatically goes up by the same amount. Not every lender offers this. You need to work with a mortgage broker who understands this product. Step 2, every time you make a mortgage payment, a portion goes to principal. That frees up room in your HELOC. You borrow that amount back from the HELOC and invest it in income-producing investments, Canadian dividend stocks, diversified ETFs, or, and this is important, you can use it towards an investment property. Step 3, because the HELOC money is now an investment loan, you deduct the interest at tax time. That gives you a tax refund. Step 4, and this is what accelerates everything, you take that tax refund and put it right back against your mortgage principal, which frees up more HELOC room, which you invest again, and it becomes a cycle. Let me give you a real example. Say you have a $500,000 mortgage at a 25-year amortization. Your marginal tax rate in Quebec is around 45 to 50%, depending on income. Over the life of this strategy, you could save roughly $80,000 to $100,000 in tax deductions alone. And at the end, instead of just having a paid off house with zero debt, you have a paid off house plus a substantial investment portfolio, potentially over millions of dollars, built from money that was already going to mortgage payments. Now, here's where most Smith Manoeuvre videos stop. They tell you to just buy dividend stock and call it a day. And that's it, it's fine. But I'm the real estate professional and I want to show you how this connects to property investing, because that is where it gets really powerful in my opinion. Option 1, you invest the HELOC funds into dividend-paying stocks or ETFs, solid, proven, lower effort. The interest on the HELOC is deductible, the dividends compound, and you build a portfolio over time. Option 2, and this is what I find exciting. You use the accumulated HELOC equity as part of a down payment on an investment property, a Plex for example. Now, you have rental income covering the investment mortgage. The HELOC interest is still tax deductible because the funds went to an income producing asset and the property itself is appreciating. In Quebec right now, Plex prices are up 8% year over year, according to the latest board's data from the Centris database. You're building wealth on multiple fronts. There's also a technique called cash damming that landlords can use in combination with the Smith Manoeuvre. The idea is to route your rental income and business expenses strategically to maximize the portion of your debt that is tax deductible. This gets into advanced territory. Definitely work with a CPA on this, but the core principle is the same. Convert bad debt into good debt. Let me be very clear about who this is for and who should stay away. Good candidates. You have stable, predictable income. You have a long time horizon, at least 10 to 15 years. You're already maxing out your RSP and TFSA, and you're looking for the next wealth building lever. You are comfortable with the concept of leverage, meaning you understand that borrowing to invest amplifies both gains and losses. And you're disciplined enough to not touch the HELOC for personal spending. Now, who should not do this? If the idea of borrowing to invest makes you anxious, this is not for you, and there's absolutely nothing wrong with that. If your income is unpredictable, think freelancer, commission only with big swings, be very careful. If you're close to retirement and cannot wait out a market downturn, skip this. If you have high consumer debt on credit cards, car loans, etc., pay those off first. And if you would be tempted to use that HELOC to renovate your kitchen or take a vacation, this strategy will backfire. Now, this is the part nobody wants to talk about, but it's the most important part. The CRA, Canada Revenue Agency, audits investment loan deductions regularly, and they're very specific about what qualifies. Rule number 1, there must be a direct traceable link between the borrowed funds and the investment. You need a separate HELOC sub-account for Smith Manoeuvre transactions and a separate non-registered investment account. If you mix personal spending with investment borrowing in the same account, the CRA can deny the entire deduction. Rule number 2, the investment must have a reasonable expectation of income. Dividend-paying stocks and ETFs qualify. Growth stocks that pay no dividend are a gray area. Crypto? No. Real estate that produces rental income? Yes. Rule number 3, keep everything documented. Every HELOC withdrawal, every investment purchase, every dividend payment, every interest charge. If CRA asked, you need to show a clear paper trail. And let me say this plainly, you need a team. A mortgage broker who understands readvanceable mortgages, a CPA or tax professional who knows the Smith Manoeuvre compliance rules, and a real estate advisor like me if you want to connect this to a property investment. Do not try to do this alone. 2 big risks to name explicitly. 1, market risks. If your investments drop, you still owe the HELOC. This is leverage investing. It amplifies losses just like it amplifies gains. 2, interest rate risk. HELOC rates are variable. If rates spike, your borrowing cost goes up. The good news is the interest remains deductible even at higher rates, but your cash flow takes a hit. The Smith Manoeuvre is not for everyone, but if you are a homeowner with stable income sitting on a property in a market that is appreciating, especially here in Quebec, this might be the most powerful financial move you can make. You are literally turning your mortgage into a wealth building engine. If you want to know whether this could work for your situation, book a call with me. We can look at your numbers, talk about your goals, and figure out the right approach for you. Link is in the description. Again, I'm LJ Aguinaga, your Montreal real estate expert. And if you found this valuable, like and subscribe. I'm putting out content every week on how to build wealth through Quebec real estate for homeowners and investors. See you in the next one.